Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's December the 8th, 2018. Well, we've had a very volatile couple of months here, really, the fall, starting in September, October, November, now into December, a lot of choppiness. So I thought it was time to give another update in terms of how we're approaching the markets and some of the key items that are moving the markets and best way forward. So let me just jump right into it. So on the slide in front of you, you'll see a disclaimer. And of course, just read through that quickly and that'll cover off all our legal liability. But on the next slide, it says video update. I'll call this slide 1. And here we'll talk about the current market update. Markets bounced back a wee bit in November after a crushing October. But we're also seeing now in early December, this past week, some drops in the market. So let me speak to that issue in just a moment. Interest rates back off. Actually, we've seen rates going up for the last year and a half, and now they've come off a little bit. And that's because of economic worries. We'll talk a little bit about that. And then areas of opportunity and where we're staying focused in terms of our long-term investments. So we'll continue here on the next slide. We talk a little bit about market update. What's actually happened year to date? So as of January 1 through December the 7th, you can see that the TSX in Canada is down about 8%. And so that's the broader market index. In particular, the area that's just been hammered this year is the oil and gas sector, and many of you know the reasons for that. Both global reasons and also some of our own Canada-imposed reasons. We can't get our oil out of the center of our country, and therefore it trades at massive discounts, and this is really hurting much of our energy sector. We've also seen that the S&P 500, which is the broad index of the largest companies in the United States, is down about 1% now. It's been up most of the year, but now down 1%. The NASDAQ, which is the technology-laden index, is still up 1%, and it's probably one of the only positive markets anywhere in the world in terms of equity markets. And then the FTSE, which is the FTSE, the London Exchange, is off about 12%. The German market is off over 16%. And then on the next slide, we'll continue with some of the market update. You'll see that the China market is down 21% as they take a big hit from some of the pressures that the US government is putting on them, and also just some of the excesses that have taken place in that country for many, many years. Hong Kong down 13%. Japan is down 5%. Oil, as I just made a comment earlier, is down 14%, but it rose an awful lot in the first 2 quarters of this year, and it's now down 30-40% from its high this year. So year to date, though, down 14%. Gold is off about 3%, a very small amount. And good old Bitcoin, our favorite cryptocurrencies. We did not invest in any, as our investors know. That's down 75% year to date. Now on the next slide, and I just on the bottom there, I should say, the Rocklinc accounts are around 1% or so up so far year to date. So we're hanging in there quite well with conservative portfolios. Now on the next slide, just talking a little bit about the cryptocurrency space. I came across this just this morning and I thought I'd just relay it to you. So if you look at the crypto space, and we did not invest there, as we told our clients, we didn't understand the area, it didn't make any sense to us. I don't know how you put values on things that are just digital and virtual and can be created out of thin air and so on. So we stayed clear of the space, but for your interest's sake, because there was an awful lot of interest in this space about a year ago. And that's now waned, of course, with the prices coming off. You can see the drops in the major cryptocurrencies from their high. And this is from their ultimate high. So BitConnect down 100%. In fact, quite a few of the current cryptocurrencies have gone to zero. And you can look at that at your leisure and see what's happened. And then right at the bottom of that list, you see Bitcoin, which is off about 83% from its high. So It's a very volatile area, very risky area, and one that we have stayed clear of because of that. It doesn't meet our investment philosophy or your priorities. So just continuing here on the next slide, we talk a little bit about interest rates and what's happening there. In fact, interest rates, as we say here, are edging lower. Pressure's coming off of bond prices, so as interest rates come down a little bit over the last 6 weeks, bond prices have come up, and we expect increased volatility, which will give us more opportunity over the next little while because of interest rate changes. Interest rate changes are ultimately moving because of concern over the economy. If rates are going up, the economy's hot. If rates are coming down, people are concerned that the economy's cooling and things aren't as strong, and there could be a recession in the future, and so rates come off. If you look at the bottom of that slide, slide number 5, you can see that Canadian government 10 years and the U.S. Treasury 10-year, which these are sort of benchmark bond yields to look at, are now down 46 basis points, or 0.46%, a little under 0.5%, and also 0.38 or 38 basis points in the case of the U.S. Treasury over the last 30 days. That's a fairly big drop, and over the last 12 months, they're still up, but we've given up most of our increase just in the last 6 weeks as a result of concerns over the economy. And in fact, as I say in the bottom of that slide, you have what you call an inversion in the yield curve, and that means that the shorter term rates are longer than some of the longer term rates. And so we're starting to see this inversion, which means that the market is expecting a potential recession, and that's when the 2-year yield, if you bought a 2-year bond, you'd actually make a higher amount of interest than if you bought a 5-year bond. That's what we mean by inverted. And so that's telling us the market is very concerned about a slowdown. And so we need to pay attention to that and be on our guard and be very careful in terms of how we invest. Now, what's driving this? On the next slide, I'm going to give you 6 points, and we've got one more on the next slide after that, 7 points of sort of what's driving this volatility, what's driving the concern in the marketplace. Well, number one, concerns over slower economic growth. I've mentioned that already. And around the world, actually, there's very little economic growth. Almost all of the growth really has taken place south of the border of the United States. A lot of that due to tax cuts and a much more investor-friendly economy. Second, high debt levels around the world. As we've talked about over the last number of years, debt levels have gone up, 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 up and away. And so as rates come up, people have a tough time funding the debt. And so it shouldn't surprise us as rates come up that the economy is going to slow and people are going to get more concerned about debt levels. 3, the impact of higher interest rates and less money printing. And at the end of the day, what I would emphasize to you is that there's been a lot less money printing going on. And in fact, in some cases, central banks are pulling money out of the system, which means quantitative tightening. And so that's going to have an impact on the economy. 4th, trade frictions. And again, you've heard about this, you've read about it. Donald Trump is trying to reorder trading rules around the world and trying to get some of these trading imbalances out of the system. And that's going to clearly put pressure on the global economy. Any change is going to cause people concern. And we've talked about that. High valuations in the stock market already. The market is not cheap. And so whenever things are at a high level, there's more risk of it coming off. 6, political pushback against globalism and the sort of global elite. There's a lot of unrest as governments have pushed taxes higher and higher, put energy costs up higher. Even as I'm doing this video, there's riots going on in France, Belgium, Italy's in disarray. I mean, I could go through country after country as a lot of the people on the street are saying enough is enough, and they're tired of the onerous taxation and government intrusion into their lives. And so this is causing, again, more volatility. And then on the next slide, we're having a little bit of fun here. I would suggest that you have to be careful that you don't get too preoccupied with the news, and you focus on the fundamentals of the companies. And that's because there really is so much fake news out there, and it's hard to know often what is true and what's not true. And so I've just put on this slide here, slide number 7, be very skeptical of the mass media. Most of them are suffering from this Trump syndrome, I will call it. They're still in denial that he's been elected, and they just attack him and attack him and attack him. And whether you like Donald Trump or not is not really the issue. But you just have this preoccupation with Trump and not really covering the news as it is. And that can get people frustrated and sort of uptight. And again, I think it just causes people to focus on the wrong things and not on long-term fundamentals and on the businesses, particularly when it comes to investing. And so I have this little funny comic here in regards to CNN, which I think most of us know is peddling nothing but misinformation most of the time. And so please try not to watch CNN if possible. Try to get your news from other sources, or in CBC also, which now is just a tool of the Trudeau government in Canada. So you have to be very careful of it also. But the point is, focus on the fundamentals. Don't get too caught up in all the news. And then in terms of the areas of opportunity, as we've talked about before, our companies are performing well, and that's what we focus on. We think precious metals are really low, and we've seen good uptick really in the precious metals and precious metals stocks that we own in October, November, and now December. We expect them to go a lot higher regardless of what the market does. Large dividend-paying securities are going to be very important for our portfolio, and some of those are cheap. As rates have gone up, people have sold them down. As rates now start to come off, we think they're going to go up nicely. Nibbling at some of our favorite companies, taking advantage of the volatility, and then active research, ferreting out more and more companies, new companies, and making sure the companies that we're invested in are delivering the results that we expect and ultimately will create long-term wealth for clients. On the next 2 slides, I just emphasize again the 8 sectors where we spend a large portion of our time, not all of our time, but certainly a large portion of our time. And so you can see on slide 9, infrastructure businesses we continue to study and look at a lot of infrastructure companies. It's a long-term great area to be. Financial, but very careful about leveraged financials, and very careful about global banks and banks that are leveraged to the global economy or have balance sheets we don't understand. So we stick really to the domestic players here in Canada, and buy a lot of alternative lenders. Third, technology businesses. Technology is here to stay, and the volatility in the market is giving us better entry points on some of the tech companies. Manufacturing companies, as we've talked about already, companies like Honeywell, companies involved in automation, TE connectivity, etc. These are great companies. Precious metals, I mentioned already, healthcare, agriculture, and water. Can you get 3 more important areas than that? Healthcare, agriculture, and water. And we've got some great companies in those spaces, and they certainly are not going away. And we see great long-term opportunities. So on the slide number 11 there, disciplined value approach is what we're using in this market. We think, again, the greater the volatility, the greater the opportunity for our investors. What matters? Valuation risk. So we have to be careful what we pay. Quality risk. Make sure we're buying the best quality companies based upon the fundamentals of those businesses. And portfolio risk. Putting those companies together in a portfolio effect for you, so that we're not just in one sector or a couple companies. We've got good diversification, and that gives us a wonderful portfolio effect. So with that, I want to wish all of our clients a happy holiday, Merry Christmas, and a wonderful, wonderful new year. And remember, last year, we talked about looking forward to the new year. And last year, I got one of my most precious gifts from my research analyst, and I'll just hold this up to you. And it says, make Trudeau a drama teacher again. So we're having an election in 2019 in Canada. So if it's going to be a really, really good year and a happy new year, it'll be a year in which we elect a different government. So, Merry Christmas and have a Happy New Year. And we'll be back to you early in the year with another update. And we'll be also sending you some other information, probably even before the end of the year. Thank you very much. And we appreciate your patronage, your support, and we look forward to continuing to service you in 2019. Bye now.